Well, welcome everyone to today's webinar. As always, we have a great webinar in store for today. I appreciate everyone sending their questions. We have a lot to talk about. It's been a eventful quarter and an eventful July so far. So lots of things to discuss. So we will hop right into today's topic. We're going to be covering the market update. So going through what's happened so far in 2024 and then our outlook for the remainder of the year. And there's again no shortage of items and issues to discuss and to be aware of as we head into the end of 2024. I encourage everyone here on the webinar, if you've not done so, check out our website at keenwealthadvisors.com. You'll find our podcast, also our blogs. Those come out every week, and then copies of our replays of our webinars, which you'll find there as well. And upcoming events, live events for those that are in person, events for virtual events as well for those that are out of town. Again, you'll check out all that at keenwealthadvisors.com. And then also, if you'd like a copy of Mr. Keen's Amazon best-selling book, Keen on Retirement, Engineering the Second Half of Your Life, please send me an email, mwilson@keenwealthadvisors.com. Happy to get a copy sent out to you, and we will do so at our expense. And then lastly, we've started a YouTube channel. Replays, they're on our website, but they're hosted through YouTube. So you can check out our YouTube channel. I believe it's youtube.com/Keen Wealth Advisors. That is our handle. Go check it out and subscribe. More and interesting content will continue to be posted there. That won't be hosted or posted anywhere else. Okay, let's get into it. Let's talk about the markets. It's been, as I said, an interesting first half of the year. This is a graph of various asset classes going back to the beginning of 2024 through just a couple of days ago, and looking at the various indices that we review. We have the big ones that you'll find on the financial media: the S&P 500, the NASDAQ, and the Dow. Those are fairly common to see the performance of those, or at least the numbers related to those. We're over Dow 40,000 currently, S&P too hitting all-time highs, and the NASDAQ as well. So I mean, things are just progressing along in the right direction. We have small cap stocks listed here with the yellow graph represented by the Russell 2000, and then some international positions that represent holdings that are headquartered overseas in both developed markets and emerging markets. And the reason I point these out is because they are a representative of a diversified portfolio. You'll find some similar holdings between the Dow, the S&P, and the NASDAQ. Less so with the Russell 2000 and the emerging markets positions and the international positions. Those, those have different criteria, so you generally won't find those in any of these other holdings. So it does show, again, kind of the performance across the board. And there's definitely some things that are performing well, and primarily it's large companies. And large companies that are considered growth companies. That is a definition that we use in the industry. You might say, well, we want them all to grow, so should they all be growth stocks? And the term growth essentially just means that the company is in a market share acquisition stage. This is a simplistic definition, but essentially they are reinvesting proceeds, profits, what have you, to continue to grow their market share and grow the business. Does not mean that other companies are not doing that, but they may be more established and they have the dominant market share, and there's less growth opportunities in that segment. So they could be looking at other segments, they could be looking at other markets, so international markets where there is a larger emerging middle class, and those companies could be looking at those markets. So it's kind of a interesting term, growth stocks. Those other companies that I discussed that said they are more established, those are called value stocks, and just kind of different terminologies to explain what phase the company is in. And growth stocks have been very well performing this year, and the S&P 500 has a large percentage of their holdings in that growth category, and the NASDAQ as well, whereas the Dow would generally have more of the value companies, and you can see the difference in the performance there. There's not a, again, right or wrong, whether the Dow's right or the S&P's right. It's more so of just representative of the different components that make up those holdings. The different sectors that make up this is actually for the S&P 500 in particularly, which is representative of 500 companies, generally on that large company size scale. And technology is the big performer, which is a big portion of what that growth category is, followed by communications, financials, utilities, industrials. You can kind of see down the list where real estate is the lowest performer for the year, and that's representative of what are called real estate investment trusts. And those companies, publicly traded companies, they invest in different types of real estate. So you might see some that are focused on commercial, others that are focused on hospitals and kind of different categories, some in storage, some even look at real estate as what are the cell phone towers. That is a different kind of really subcategory inside that real estate market, but what that represents. The interesting thing this year is, financials performing well, utilities, can be a little less interest rate sensitive, same with financials, so you expect those to be up there. Technology and growth companies, when interest rates are higher, the expectation is that the cost of capital is such that it would reduce their growth opportunities, meaning it's going to cost them more to grow their business. And that was reflected in 2022. That was the year that the market was experiencing these more significant interest rate hikes, and the different asset classes were performing differently in response to those interest rate hikes. Technology, communications, those were very poor performers that year relative to some of the ones that are less sensitive to interest rates, like utilities, consumer staples, things like that. So kind of interesting to kind of see how it's all being broken down in these different areas for 2024. Moving along to fixed income. So this is the yields of current United States Treasury bonds. So this is, when you loan your money to the government, this is the rate you receive. And, you think about, okay, well, why do we talk about that? Well, the U.S. government is considered, the most stable and I guess secure financial system in the world. I mean, maybe some people would argue that there's maybe some small countries overseas that could have some more stability, more security around that. However, those countries are so small that investment in those areas is limited by the size. Our treasury market is by and large the most significant in the world and very liquid, so money can flow in and out of treasuries very easily, and not so in some other areas. And so yields are important. And when I look at the US Treasury yield, I mean, what that represents is a zero credit risk for the most part. This is kind of how the market views it. Zero credit risk yield. So you don't have to worry about the US government defaulting on the interest payments. They never have. Not to say that they won't in the future, but I don't see a scenario, market does not see a scenario, no one's pricing in a scenario where the government just decides not to pay the interest. And we know that they have unlimited ability to print money, so there is really no reason for them to ever not pay the interest that is owed to the Treasury bond holders. So really what this represents is just, okay, is this a place to park money that is going to provide us some stability with fixed interest payments and a return of our principal? Well, in the interim, while you own those bonds, the yields fluctuate every day, and this is what this chart represents: is every single day the yield if you were to purchase a new bond. But the existing bonds, they change, their value changes based on current yield. So even though you might hold it to maturity, if you wanted to liquidate it, if you needed to liquidate it, you might have to sell it for less than what you paid for it. So even though there's no risk from a default standpoint, there is what we call interest rate risk, which means the farther out you go in maturity, the more sensitive that bond is to interest rate moves. So long-term bonds, very, very sensitive to interest rate moves. Short-term bonds, less so. I have another graph here that I'll show you that kind of represents that. But what this is also a reflection of is what market participants maybe think where rates are going, because this is not controlled by the Federal Reserve in the same way that the overnight lending rate. So when we talk about the Fed raising or lowering rates, that is what they are doing. They're raising or lowering the overnight lending rate. They are not raising or lowering Treasury yields. That is a whole different, different segment that they don't control. Now the Treasury Department controls that, but they just issue bonds. There's an auction, and that's what determines the yields. And based on where the demand at the auction comes in, that's where the yields end up. And they're not going to be wild swings. You're not going to see an auction that all of a sudden just way higher or way lower. You can see how it fluctuates on a day-to-day basis. And so as more demand shows up, yields go down. So you're seeing people sometime in end of April, early May, there's more demand, I would say, that showed up and has been there that is reducing yields because more and more people are locking in these yields on these different maturities. So the blue line, you have the 10-year Treasury, the orange line, you have the 5-year Treasury, and then the blue line, you have the 2-year. And this has been a common issue for the last several years. The short-term bonds are yielding more than the long-term bonds. People might think, well, why would that happen? Well, one, interest rates on the short end, which is what the Fed controls, that overnight lending rate, are higher. So you are getting paid to own more shorter term assets. But then two, the future expectations for inflation is kind of one thing. Future maybe risk appetite as well as maybe another way to think about that is people are buying longer term bonds because they want to lock in these yields because they think maybe these yields aren't going to maintain. Fed's going to reduce rates. And so we want to lock in a 5 or 10 year at this rate, knowing that maybe they will be 3 or 2% a year from now, 2 years from now, whatever that looks like, and inflation too being lower. Because when you look at yields, what you really want to evaluate is, am I receiving enough interest to outpace inflation? I mean, that is one way to look at it, and that's kind of a significant way I think people kind of like to think about that in the investment world is, am I being compensated for, you know, current what current and future inflation expectations I have. Here's the performance. So as I was discussing earlier, how bond prices change based on yields. This is a few more buckets of bonds. So the previous page had yields. This is actual returns. And we've got the longest maturity bonds represented in this orange category. And as interest rates were going up through, this is going back to January of this year, going up throughout the beginning of the year through the end of April, your existing bonds go down in value because people can get higher interest. So your current bonds that you would own are not as attractive. So you have to sell them at a discount for someone to actually want to buy them. We're performing poorly. And this is following a very poor performance in 2022, and kind of okay performance in 2023. You know, interest rates are bouncing around. So when they're in a more stable period, you don't see as much of this fluctuations, but interest rates have been fluctuating. And almost down 10%. And this represents bonds that are 20 years or longer in maturity. And these are all US government bonds too, by the way. So it does not factor in any default risk because there isn't any, you know, that the market foresees with the US government. Now, interest rates at the end of April have been coming down. So bonds prices have been coming up. So vice versa, when yields come down, your existing bonds are more attractive and prices come back up. Now, still not as attractive, you know, you're still down on the year. And then if you look on the right-hand side where our mouse cursor is, you'll see the colors and how the shorter maturity bonds and treasuries are performing the best, and the longer term, longer duration bonds and treasuries are performing the worst. This is, you know, when we look at the fixed income bucket in people's portfolios, you know, first and foremost, we want stability and the ability to know that this money is there should a adverse event come up. If you know, as we traditionally we rebalance because equities go up over time, the stocks go up over time. We sweep a little bit of the profits over, replenish the fixed income, and then each year, you know, live off the fixed income and keep replenishing that. And that works great. Now, there's occasionally periods where the market's down and we don't want to liquidate any of the profits on the equities, on the stocks. So we're going to live off more of the fixed income. So we want to have a certain number of years of someone's distribution needs in the bond or the fixed income bucket. And we don't want to take on a whole lot of interest rate risk. And especially currently, but even more so the last several years because interest rates were much lower and you weren't compensated for taking on that interest rate risk. So we'll tend to be on the shorter end of interest rates, and because that does provide more stability. You just don't have that risk. However, there are opportunities from time to time where yields are attractive, and we'll look at a portion of someone's bond portfolio and say, hey, maybe there's an opportunity to lock in a little bit longer term rate and look at a capital appreciation type of investment, meaning we expect rates to come down, longer term treasuries, longer term bonds go up in value, and we can lock in some profits on that. And we could be getting to a point there. I mean, that's not necessarily what this chart is analyzing or representing, but are we at a peak in interest rates? You know, a couple of things that I'll share as we go throughout today's webinar. Moving towards the economy, I always like to give everyone an update on the indicators, economic indicators. This is just a you know, a handful that I follow. Actually, there's a lot more that I look at, but in our investment committee here that we all look at. But these are the main ones, and I like to focus on those. So one, there can be a lot of things, and sometimes there's a lot of noise with the economic data. So you have to look over long-term trends when it comes to it. And these are the ones that I find are the most valuable for what what someone should be looking at. I always like to talk about the number of jobs that we have here in the U.S., or at least the number of people working. This is a graph. This is all from the St. Louis Federal Reserve. They have a economic database that is online, and there are more than anyone probably ever cares to view, but tons of data points, lots of historical data, data that they don't even look at anymore, but they still have it out there and you can see it. It's just not going to be updated. All that, lots of stuff out there. And these graphs all follow the similar format. The gray shaded areas are recessions, and at the bottom here we've got the time, and of course we have the value here on the left hand side. So this one looking at number of employed people in here in the US going back to pre-COVID 2019. We had 152.5 million workers pre-COVID. Now we're up to 158.6 million post-COVID. And we continue to add jobs here in the US. That is the takeaway from this, is that this number is continuing to go up and to the right. Yes, the rate of growth has slowed, and that's okay. That we don't have to have $1 million a month or 1 million jobs a month added to the US economy. It's not necessary. Excuse me. So, but we do need to have steady and consistent job growth. That is important for an economy to grow and function, is you have to have labor. There's really, in a very simplistic way, kind of two components to economic growth. It's capital and labor. And there's no shortage of capital. We've kind of learned that over the years. Government and markets can come up with all the capital. Now we just need labor to execute. And this is the next graph is job openings. Significant amount of job openings post-COVID. That was a big issue. That number has been steadily coming down, still higher than it was pre-COVID, but job openings are getting filled. Less need for workers. Still a lot of need for workers, but less need for workers than there has been over the last couple of years. And why is that important? Well, part of the reason that it's important is because when companies can't find employees, that hurts their revenue and ultimately flows through the balance sheet, ends up as earnings, and can hurt their share values. If they're publicly traded companies, we can find that reflected on the stock market. If they're private, the net income is what is distributed to the shareholders. So if they can't find workers, ultimately they feel that they're going to be not at full capacity, and we want companies to be at full capacity. Looking at job losses, because that's then kind of the next thing. Because if I think about it, as I talk about this when I update these quarterly webinars and have meetings with clients, the reason we talk about the jobs market is because our economy here in the US is a consumption-driven economy, meaning the majority of our economic growth in a given year is based on what us as individuals spend money on. And if we have a job, we are more likely to spend than if we don't. So that is the kind of the simplistic way to look at it. Consumers, by and large, don't do a good job saving, but they do a good job consuming. And that shows up as revenue, which then turns into earnings, which then is reflected in the value of the stock market. So that's kind of the reason why we like to talk about jobs, because as job losses begin to pick up, that could be offset by job gains. This is what's currently happening. We're having positive job growth, but at a certain point, there will be more losses than job gains, and we will have negative job growth, and that could indicate a turning point in the economy. That could be a peak in the business cycle, and then all of a sudden now we're going to be trending lower. And by going down that whole formula I just described, revenues down, earnings down, stock prices down. So looking at the job market can give us an idea. And this is when folks first file for unemployment. We want to just understand kind of, all right, are people long-term unemployed? How is that looking? We're at the same level as we were pre-COVID. You can see we had a significant spike in COVID. And when we actually look at this on a long-term chart, it's at some point we may have to kind of almost crop it out because it just kind of skews all the data because of the way this spike shows up. But on this zoomed in version, you can kind of get the idea here that yes, we've been on a steady, kind of looks like it could be trending a little bit higher. It was lower before, but it's been, if you go to the website, you can hover over each data point and kind of see where it's at. It's been on a fairly steady spot for for many quarters now. Retail sales, this is a way to see, okay, consumers are spending, they have jobs, they are spending, shows up in retail sales, continuing to increase, not quite at the same rate as it was before, but still in a positive manner. Housing, housing has continued. If you kind of, I draw this red line to give you an idea of the trend. And yeah, housing can have these spikes in there, and we're seeing a little bit of a slowdown now. Summertime, it can, based on what's going on. You've got the hurricane down in the southern part of the U.S. I mean, all those things kind of impact everything. On a short-term basis. We'll continue to watch this data, but housing, it is a big component of the economy, and we like to keep an eye on housing. This is one of the items that many people thought was going to be significantly impacted by higher rates. Yes, it was on a short-term basis, but it didn't just crater. And actually, housing prices have continued to increase, even with rates as high as they are. This is new building permits, so this does not show anything related to existing home sales or anything. This is just new building. And you kind of see what's going on there. But the reason home prices, and our analysis throughout that whole time, was that we expect a slowdown, but not a crash in housing, and primarily because inventory, so new and existing homes, there's just not enough of them to meet the demand of future homeowners. Going back to 1982, this graph shows the housing inventory. You can see the long-term average over that time frame. We're looking at 40 plus years and kind of where we're at as of February of 2024, and have been since, call it 2010, 2011, where we've been below that long-term average. Housing got so significantly oversupplied through the housing bubble in the first part of the 2020s, or excuse me, the first part of the 2000 through 2010. And since then has, it's struggled. It really has struggled, and now we're seeing the impact of that. House prices are significantly higher because of the inventory. It's just a function of supply and demand. National Home Price Index continues to increase over the last, this is for 2023, basically January 23 to January 24, nationally at a 6% rate. And even if you look at current data, still on that same trend. So home prices are continuing to creep higher. Business spending, so this is what businesses spend money on. So I talked about our consumption-driven economy. Well, it's nearly 70% of our economic growth every year is consumption. And then, there's 20 or so percent that is business spending, which is what this represents. This is, not all business spending, but a large portion of business spending. And then you have government spending as the other portion. And then we have the impact of our imports versus export. So we import more than we export, which actually takes away from our economic growth according to the calculation of GDP. So business spending has been, just chugging along, not increasing significantly, but at the same time, it's still high, and businesses are continuing to spend, which is the key takeaway here. And then the yield curve, as I mentioned in the earlier graph regarding the interest rate environment, we have a inverted yield curve, meaning the short-term rates are higher than the long-term rates. And this has gotten less and less media airplay, I would say, over the last couple of years, because it's been this way for some time now. Prior to, I would say, the last 15 years, the yield curve inversion was a very important thing to focus on. And I don't want to say that this time is different, but I do want to put the current interest rate environment in context to our previous interest rate environments. So we had yield curve inversions prior to recessions. You see the gray bars here? Gray bars. And this, if you went back, yield curve inversion there, gray bar, gray bar, gray bar. I circled them, and that means longer term rates lower than shorter term rates. Fed most likely in a tightening cycle, meaning the Federal Reserve is increasing interest rates, inflation could be increasing, things like that. So they're trying to slow down economic growth, reduce inflation by tightening up the money supply. They want people to park money and earn interest instead of spending it or reinvesting it. That's why they raise interest rates, to entice people to do that. And ultimately they historically have raised them too far, is kind of how some people would interpret that, and inverted the yield curve. And meaning, okay, money's tight, cost of capital is high, businesses are now having to make decisions because it's not as easy to finance future operations when they look in, okay, well, if we have excess cash, we can earn interest on it versus what is our calculation for our return on investment and things like that. And two, if we have a economic slowdown, how do we handle that? So they have to make all these decisions when interest rates start to increase versus when interest rates are low. Return on investment, much easier calculation to justify spending money because you're not earning much by leaving that cash in interest-bearing investments. So these inversions have historically led to recessions. Kind of see that play out. Well, what I will say this is I don't believe the yield curve inversion predicted COVID. That is not, this recession was government mandated, very short and unique in many, many ways. But since the 2008-2009 global financial crisis, where the equity markets were down 60% from peak to trough, I mean, it was a significant event, and you had the chairman at the time, Ben Bernanke. They were coming up with all of these different ways to pump capital into the financial system, the TARP and all these different acronyms. I mean, I can remember watching this on, on the various financial media as this was happening in 2008 and 2009. Lehman Brothers failed in September, and basically everything just went haywire after that. And they acted quickly at the time based on how they've done in the past, cut rates, influxed capital. They then started utilizing their other tools like quantitative easing. So they were outgoing and purchasing government bonds on the open market, which, as I described earlier, creates demand, which reduces the yield. So they were intervening in the public markets to keep interest rates low. And since the last several years, as they've been raising rates, they've also been what they call quantitative tightening, they've been letting all those treasury bonds that they purchased mature and not repurchasing them. So the yields are allowed to creep up because there's some portion of the demand is not there anymore, which, you know, would allow yields to go back up. So these yield curve inversions, the reason I explain all that are they were manipulated by the Federal Reserve over the last 15 years to keep yields down. Now they're kind of letting that go away. And I believe the financial markets and the financial system and even the cost of capital and everything else is not reflected in the same way that it was in these previous yield curve inversions when the Federal Reserve was not utilizing those tools at all. I mean, they were not as involved in the market the same way as they have been over the last 15 years. So when you have that, you've got these yields that have been, you know, out of whack relative to what the market would really have priced them at. So trying to get to a normalization is it's going to take some time, and that's why the yield curve inversion, again, less and less of an issue as time goes on. All right, let's talk about earnings. I think this is maybe people's favorite graph that I cover when you know, when we go through the webinars. And you know, as you know, as I talk about this, and the reason we talk about earnings is because stock prices are a function of earnings. Yeah, there's a lot of different day-to-day kind of noise, but ultimately that's just what stock prices are. They're a function of earnings. And over time, because yeah, okay, we're at Dow 40,000, and you know, it's common to hear the question and for people to ask, it's like, well, gosh, it's so high, it's got to come back down. And well, sure, I mean, it can, and we have volatility and markets fluctuate, but it's as long as earnings go up, then the value goes higher. So when I have my Dow 100,000 hat, you know, right here, can't miss it. If you come to the office, you'll see it. Dow 100,000. Well, at that point, let's just double earnings right now. We're 2024, 243. Well, in, let's say it's 20 years, it's 500. So the valuation, which is what my next slide is describing, is the same because earnings increased. So if the Dow doubles, you expect earnings to double. That's kind of how the market, you know, works. And again, very simplistic way, but just think about it that way. And look at these earnings. This is going back to 2014, $120 a share in 2014. That's what this is based on, all the companies in the S&P 500, what the earnings per share for each company times the weight in the index to get you the earnings for the year. 119, you know, call it 119, you know, very stagnant for a few years there. It doesn't mean the market was flat because interest rates and other things kind of fluctuate. And the market's a forward-looking mechanism, you know, discounting future earnings back into today's prices. You see higher earnings, okay, COVID down, 21, 22, 23, here we've got 24, and then 25. Well, earnings, they've doubled if you look at it from 2014 to 2043. Now this isn't finalized. 2024 is not over. We won't know the final number until Q1 of 2025. So we've got some time there, but let's just say that's what happens. Well, earnings doubled, but the stock market, if you look at it back then, has gone up a lot. And I don't have the exact Dow data. It was actually in 2020, I think the Dow went through, 20 then 30,000. So, but think about that. It's like earnings double, well, stock prices double. And again, the valuation is the same. And, we look at, okay, yes, we're looking at what's the remainder of 2024, but then as we go through 2024, the market is discounting back 2025's earnings. So earnings expectations for 2025 are at $278 a share. So by year end 2024, the market, should be pricing in 2025's earnings. And if economic data changes, well, then the market will price in, let's say it changes to the negative, and towards the end of this year, well, then the expectation for 2025 could be lower, which then is pricing in a lower market value at that time. It's this kind of forward-looking discounting mechanism is what the kind of the whole of the market is. So if we look at year-end 2024, we take 2025 earnings and we apply a multiple. And that's the part that is kind of always changing every single day, because you can bring it back and say, well, what is the current multiple? Well, if we use the 278 as our future earnings estimate, and we apply a 18, 20, 22, because that's kind of where the market is currently. Now, if the market currently had a multiple of 10, we'd be applying a different calculation here. But the market currently is at this. And there's an argument to be made that as interest rates increase, multiples could go down. And vice versa. As interest rates are low, multiples go up. That has not been the case because interest rates have increased throughout 2022. They've been steady here for the last year and a half, and the multiple hasn't changed much prior to interest rates rising. So future expectations are that multiples could stay high. And what are the things that impact multiples? Well, if you have a lower multiple, there's just probably more uncertainty about future expectations, less transparency, things like that. Well, the market has gotten better, more efficient. So trading costs have been a significant a benefit to everyone. Look back, 50, 40, 50, 30 years. I mean, the market used to trade in eighths. Some of you might remember that, like it would be 20 and an eighth. Well, that's a trading cost because there's a bid and an ask. There's a spread there. And as those spreads have come down to pennies, that's a trading cost that has now been seethed out of the market, which has then gone to everyone who's a participant in the market. Well, that can increase multiples there because it's like, well, there's more efficiency. Information. You used to have to call someone to get research on stocks. And to find news, you'd watch the end of the day news report and get an update on what happened in the stock market and read the newspaper to get the stock prices. I mean, that type of information now is minute to minute on your phone. So information, there's no shortage of it, which can be a bad thing because now everyone with a keyboard has an opinion and can be foreseen as an expert, which is a whole different story. But information is much easier to get to as well, which can lead to higher multiples. People are willing to pay more for future earnings because they have perceived certainty about what that's going to look like because of the access to information. So these are all kind of key factors that all get kind of priced into the market. And these are, some of these are long-term trends. I mean, you look at future population growth trends across the world. Well, how does that impact stock prices? Well, what about the impact of AI and all that? I mean, that's some questions that we've got on that. And, we're going to cover that on some future podcast episodes because there's a little bit more in depth on AI and how all that works. But we have the S&P 500 as of July 15th, 5,600. So if we apply these multiples, an 18 multiple here puts the S&P at year end at 5,000. At a 20 multiple puts it at 5,500, and a 22 multiple at 6,100. So if we do the math on all three of those, that gives us a range of down 11% to up 8.6% by year end. And that's okay. So what's this telling us is that we could go sideways for a little bit because market has increased a lot and there needs to be maybe some time for earnings to catch up to stock prices, and that happens from time to time. That happened in the late 90s with all of the tech companies, all the growth companies. They were trading at significant multiples. I mean, crazy multiples, because everyone was discounting all these future earnings that then never materialized, and all those stocks crashed and a lot of them went bankrupt. Earnings are much better now, all those things. So less of a concern around that. But as stock prices increase and earnings lags and multiple is higher, then there can be some more and more risk. So we keep a close eye on where are earnings relative to prices and what that multiple looks like. And what the minus 11% would represent is if we had significant changes. So earnings estimate would actually probably even come down some in that scenario. Economic data turns negative. We have issues related to to the jobs market, to maybe even a rate hike. I mean, you're talking about increases in inflation. I mean, things that are shocks to the market that would reduce that future expectation of earnings, which would then bring the multiple down and be reflected in a negative return over the next few months. If things kind of stay the way they are, then we look ahead and we see, okay, 22X, 6100, that's still 8.6% by year end from where we're at today. And that's with things going well. I mean, you can kind of see what that range looks like based on current and most recent multiples. Let's talk about interest rates, because that is one of the inputs to this calculation. Is, okay, where are interest rates at, and what's the Fed doing, and what's everyone think? Well, rates currently over 5%, year end 4.5 to 5. That's come down, and there's expectation that this is as of December. So we're looking at a 0.5% to 1% drop in interest rates by year end this year. This is what the market is kind of pricing in for the Fed to do. But the market has been less and less sensitive to interest rates in the way that it was at the beginning of the year. What it's probably more pricing in is inflation expectations are coming down, and inflation data is continuing to come down. That's really, I think, more of what this is a reflection of than it is the Fed going to lower rates by 1%? Right now, I would say I don't think so. We'd probably see a significant drop in inflation for them to do that. And not to say that that can't happen, but inflation has been steadily decreasing. That's what this graph is. Peaked here in the summer of 2022 and has been on the decline. And you can see this is each month going back 12 months. So a year over year change. You can see the different components represented by the different colors and how they impact it, where energy, the green, and this is why you hear things, okay, certain inflation data excludes food and energy. And this, you could see one of the reasons is why is because it can be volatile. So big jumps in energy costs in 21 and 22, and then big drops in energy costs. So it does kind of skew the data a little bit more. So they like to stabilize it by excluding it, but they also look at it both ways. So, I mean, it's not like they're just completely ignoring it. It's just about, let's kind of look at it in a couple of different aspects. So inflation expectations are coming down. This graph represents where, again, current rates represented by the gray, and then future expectations based on the blue is what the Fed's telling us. Year end, maybe it drops 0.25%. And the market is expecting a little bit more, at least based on, that previous graph that I showed, 4.5 to 5%. This says 469. It's always kind of a combination of a couple of different things to get to these numbers. But I think that's the market's not saying if the Fed doesn't do that, then it's going to go down. What I think the market's saying is they expect inflation to be a little bit lower, which could justify lower rates. But if rates aren't lower, I don't think that's going to impact the market in a very significant way. I think the inflation data is going to be more important than actual interest rates at this moment. And you've seen yields since the end of April, early May, been coming down too, and that may be a little bit more important than what the Federal Reserve is doing on their side. Looking at peak interest rates too, there's a period where it's like, okay, well, interest rates are they've peaked, and Federal Reserve starts to lower rates. So what does that mean for the market going forward? Because on one end you have, okay, well, why are they lowering rates? Well, does that mean there's an economic slowdown? Because you look at previous times when the Fed has lowered rates, it's like, okay, now they're trying to stimulate the economy, and that's generally a period when, okay, we're losing jobs, things like that. So they want to encourage investment, encourage people to spend money, all those things to get the economy back on track, and they're lowering rates. So stock prices could be going down during that period. And that's definitely something that is common. But it doesn't just happen right away, for one, but then two, there's different economic environments as well. So what this looks at is just some of the previous rate hiking cycles, and then the peak, and then the subsequent reduction in rates and the future returns by the S&P 500, which is represented in the second to last row here. And this doesn't include, of course, the current one, because we haven't actually started reducing rates. But looking at the last 6, forward returns have still been positive. So it doesn't just instantly mean that when the Fed reduces rates, the market just goes down in value. And this is another way of looking at that, because this is 12-month returns. And again, clients asking like, hey, should we be locking in long-term treasury bonds, those government bonds, CDs, essentially kind of very, very similar in terms of their kind of risk profile when you look at treasury bonds and CDs, and lock those in. And well, one, that is more of a financial planning question than it is an investment question, because the first question I have is then, well, what is the money for? Because if it's for short-term purchases, yes, but that has nothing to do with the market and interest rates. That's a whole different idea. Now, if this is because you're deciding either to invest in the market or not invest in the market, and yields are high and you want to take advantage of that, now that's an investment question. That two different things there. So when we look at peak CD rates, forward returns, even by owning longer term bonds and the S&P, stocks, S&P 500, you look at 12-month returns, significantly better than just owning a CD. If you bought it at the peak of the previous rate hiking cycle, you see here in the 80s, 90s, 2000, this is when the Fed was raising rates, stopped, and then they started to go down. Well, this bond portion, when I explained earlier at the beginning of the webinar that yields are a reflection of bond prices, so rates coming down actually increases existing bonds. So from an investment standpoint, that's the time to start looking at, and that's kind of what I mentioned, is like, is there a component of the fixed income portfolio that could be in longer term bonds to capture the increase in prices in those bonds? It's not because the yields are attractive. That's more of an investment, a tactical shift to take advantage of that. And you see reflected in the data that is historically what happens. You see much better returns in longer term bonds than you do by locking in CD rates at a peak. Getting lots of questions on that as well. So moving over to the election, that is definitely on everyone's radar. I think the big thing here that we're watching is taxes, and specifically the Tax Cuts and Jobs Act. Permanent aspects of that aren't even up for discussion is the corporate tax rate, which was passed in 2017, the reduced tax rate, and no real issue with that. But some of the things that are potentially up for discussion are the sunsetting of the personal tax brackets and tax kind of rates. So market expectations, I think, is looking at whether it's Trump or Biden, and who wins could have an influence on what happens here. Even with no matter what party wins, I don't think there's going to be a significant impact on the tax brackets, especially on the lower end. And again, we'll have future webinars and podcasts kind of talking all through all the tax issues and potential changes based on post-election and everything else, because that'll be a key thing that we want to make sure that we're paying attention to for all of our financial planning clients that we're doing tax planning for. Interest rates too. I mean, interest rates, questions around, well, the Fed, are they going to do anything? Because it's an election year and they're not going to do anything. Well, historically, the Fed, you can look, these are all election years, and they've raised and lower rates in different cycles. So that isn't necessarily, it can feel like it at times that they're not going to do anything, but I think they do a better job than maybe they get credit for being just independent of the political parties and what's happening, and more focused on the their role as in charge of monetary policy. Okay, what's happening with interest rates and the economy and everything else, and kind of taking politics kind of out of that. Stock price returns during election years historically have been a little lower. This year, they've been great. We've had a great first half of the year. And I think one of the major reasons for that is the expectation of or the potential for some sort of change, some sort of unknown to be elected is less. So we have, currently the ticket looks like it's Biden and Trump. And well, we've been through the last 4 years of Biden. We've had Trump before, so there's less of an unknown. And I think the market is reflecting that in current prices and valuations, that the uncertainty around a new person is less so. And so if that were to change, if that ticket were to change, if it was not Biden or not Trump, then I would expect some more volatility in the market, because now we have something different and it's an unknown. So things to look at, things that we consider. Volatility too can generally be higher in election years, and again, a lot less volatility this year. I mean, volatility is the norm. Going back to the early 80s, this is the average 1%, where there's 64 1% moves. This year this is as of the end of March, we've had 10. So a lot less volatility this year than there has been in previous years. Excuse me. And generally, you kind of see markets trending sideways. This is a graph of all the different market regimes that are represented in these colors. Election day with the dotted line, and then what happens post. The kind of two outliers here. Well, 2000 was the tech bubble was bursting, and then 2008 was the global financial crisis. So things that were more economic events, business cycle events that could not even be impacted by elections. But the reason I point this out is this dotted line. It's election day. Uncertainty post-election day historically has been okay. No uncertainty, market goes back up. Doesn't matter who wins for the most part. I mean, yes, there's different regimes and different market analysis around those regimes, but less impacted by who's in office than it is just by the fact that, okay, we know it's over, it's done. Things that the market looks at historically. And just because someone gets elected doesn't mean that a specific asset class is going to do well. Now, we were actually talking about this on our podcast, and I figured I'd show the graph here. Under the Trump administration, energy, the index, the energy sector, which I showed that earlier, the symbol, the reflect, that's done okay this year. But the energy sector under Trump, because oil prices came down so much, the energy index performed terribly. It was down 40%, while clean energy was up 275%. You might think, well, that doesn't make sense. His policy was the opposite. He was pro traditional energy, not pro clean energy. So why is that the case? Well, the reason oil prices came down is, and that hurt just the traditional energy companies significantly. So that was on that side, global clean energy too. Whether it's investment or people looking at, okay, alternative sources, things like that. A lot of different reasons for that, and vice versa. When Biden got in office, okay, he wants to focus more on the clean energy side. Well, those prices came down, and traditional oil companies did really well. So, it doesn't always just kind of make sense based on who's in office. And lastly, I want to kind of close here with a little bit more on the data points for the remainder of 2024 and kind of looking out 12 months from today, because we're at all-time highs, or very close to them based on the recording, for all intents and purposes, all-time highs, and that leads people to think, well, gosh, it's an all-time high. What should we do? Well, all-time highs do happen all the time, and they tend to lead to more all-time highs. So this is looking at if we've had 20 or more all-time highs at the midpoint of the year, so as of June 30th, then how many did we have the remainder of the year? And then what was the return for the next 3 months, the rest of the year, and then of course for the calendar year going back to January? And you can see the median. I like to focus on the median here. 3%, 9%, and then 19.5 for the year. And again, that's the calendar year, so that would just put us, at the end of 2024. But this is looking at 6 months from now, or 6 months from end of June, 80% higher. Whereas just the typical year, if you just look at all years, 5.6, 71% higher. So you've got odds in our favor that markets continue to creep higher based on hitting all-time highs. And then also this looks at S&P 500 return. So, again, I use that as a generic statement for the stock market. If we're over 10% for the year, what does that mean for the remainder of the year? Okay, well, next 3 months, rest of the year, and then that full calendar year, you can see median in that same spot for the next, 6 months as of June 30th, percent higher, 82%. This data same as before because it's the average of all years. So the odds are on our side from a historical standpoint, and this lines up very well with the market multiple calculation that I shared on a few slides earlier. So a lot of things are progressing well for us to continue to be positive on our equity allocation, our stock allocation, and making sure that people are in the right portfolios. And again, we're going to keep an eye on this because our analysis will change should economic growth change, should earnings change, all those things. As those data points come out, that changes our calculation and how we think about things. Oh, clicking the button a little too much there. So yeah, we are, I think in a good spot here in the economy. Does not mean that we won't have volatility. Markets will fluctuate. That is a norm. As I showed on that volatility graph, 64 1% moves is the average. Well, there's 250 trading days. So, you can kind of do the math there. That's 20% of the days the market is fluctuating by 1% more. And that's up and down. That's not just down days. But that is that's what volatility is. I mean, that's normal. Whereas we're on a lower volatility year currently. Doesn't mean we won't that we will stay that way, but we are currently at that spot. So again, I want to thank you all for joining today's webinar. Again, check us out, KeenWealthAdvisors.com. Appreciate all the questions that everyone submitted. That definitely helps shape a lot of the content. And, in our future podcast episodes, we will answer a lot of the questions we weren't able to get to. And you can tune in for those episodes and check out what we're discussing at that time. And then also, if you'd like a copy of the book, Keen on Retirement, just send me an email, mwilson@keenwealth.com. wealthadvisors.com. All right. Thanks, everyone, and we will talk to you soon.